Good evening. Today we are going to discuss the harvesting strategies of a business venture. So, throughout this lesson, we will discuss how to plan an exit strategy, and there are mainly three methods, three exit strategies: the systematic liquidation, and then we can do a outright sales to different type of buyers, and then we will discuss about the concepts of leverage buyout and the management buyout, and finally we will discuss the process of going public. So moving on, so we know that entrepreneurs or the owners of venture will face major operating and financing decisions as venture progress throughout its life cycle. So we know at development stage, we will be mainly focusing on turning the idea into a valuable business opportunity, and all the other survival and growth stage, we will be focusing on venture's ability to create value, and then we will be focusing on recording and monitoring the venture progress. So all along this life cycle, sometimes we have to consider the possibility of venture restructuring, sale, or even liquidation. Because all the ventures, the 100% of ventures would not be successful. And even for the successful ventures, it is important to have a good understanding about when and how to harvest the venture's financial rewards. That means it is very important to identify the methods which are available for harvesting, and identifying the timing of the exit. So even for successful ventures, it is very important to have a good understanding about this uh, exit strategies. And ultimately the ventures have to endure the rapid growth stage, and then when they are entering the maturity, they have to exit. Right, so it is important to plan this exit from the very beginning, because entrepreneurs are aware that eventually venture have to exit. So therefore, they have to give a serious consideration about having a good plans to provide a maximum harvesting value for the venture investors. Because without planning, uh, we cannot decide the best method and the timing of the exit. So it is very important, as I told you earlier, to decide the timing and the method of exit. That is why we need to plan this exit strategy from the very beginning. Because if we wait until the later stages, there will be great pressure to exit. Sometimes there can be the unanticipated events that would force the venture to leave. So if the venture has to leave without a proper strategy, then investors cannot get the maximum benefit out of the company value, out of the venture value. So investors cannot reap the maximum benefit when they are going to exit if we are not going to plan the exit strategy properly. Therefore, an awareness about the exit possibilities and the timing is very important for investors to get the maximum benefit with the venture exit. And sometimes even even the venture investors, then that means the venture capitalists, they request to prepare an exit strategy, exit plan before they invest. their capital in the venture. Sometimes that is a prerequisite that is required by the venture capitalist before they commit their financial resources to the venture. And when the ventures have the uh, exit strategy, that means they have an agreement among the owners regarding the harvesting strategy or the exit strategy. Because having a formal exit strategy will always make it easier and less troublesome for the owners. Because they have discussed and previously agreed about this strategy. And as I have told you, this will allow the investors to take the maximum advantage of different exit opportunities. Right. So, the harvesting or the exit is the process of selling the ownership of a privately held business venture to realize the appreciated value of the venture to the founders and the other equity investors. Or another way we can say it as, it is a process of exiting the privately held business venture to realize the owner's investment value in the venture. It is a process of exiting the privately held business venture to realize the owner's investment value in the venture. So normally at the time of the harvesting, there can be different groups of owners to the venture. Normally can be a founder's family and his friends, angel investors, venture capitalists, even the latter stage equity providers like the second round investors and mezzanine investors. So the value of the venture should be distributed among all these parties. Okay. So as I have told you earlier, there are three main exit strategies available for ventures. There are three main exit strategies available for the ventures. So these three strategies will be discussed throughout this lesson. So the first strategy is systematic liquidation. Then the second method is outright sale. This outright sale can be done to family members, to managers, to employees, and even to outside buyers. Then the final method of exit strategy is going public. That means becoming a public corporation. So then they would offer their shares in a public share market. So let's first discuss about the systematic liquidation. Let's focus on the systematic liquidation. So systematic liquidation, this occurs when venture is liquidated systematically, distributing the venture's asset to the owners. So that means the venture owners will systematically withdraw the cash flows of the venture. They will systematically withdraw the cash flows of the venture and sell the venture assets. Right? That means over the time, they will slowly withdraw the cash flows of the venture and then sell the assets of the venture and distribute these proceeds to the owners. They will systematically withdraw the cash flows of the venture and then sell the venture assets and distribute the proceeds to the owner. So normally, the venture goes for systematic liquidation when venture does not have any growth opportunities and they want to cease their operations. right? So the ventures go for this method, this exit method, the systematic liquidation, when the venture does not have any growth opportunity and the venture wants to cease their operation. Right? As I have told you, when we systematically withdraw the cash flows from the venture, so that means there will be no reinvestments. So there is no reinvestment, there is no room for growth. So we will do this if the industry is declining, if the industry is dying, then we will not reinvest our cash flows in the business. So we will withdraw the cash flows and there will be no growth. Right? So so normally this happens when industry is declining or the market or the product. The market for product is replaced by another product. Therefore, obviously, the operations of venture would be ceased over the time. So, under that situation, ventures can select the systematic liquidation. So, I have been the example. So, we know that the demand for the typewriters eventually ceased with the introduction of personal computers. So, that means at the time, these typewriting companies, they have to go for a systematic liquidation. So now we know under which circumstances we are going to select the systematic liquidation as our exit strategy. And there are advantages as well as disadvantages attached to this method. So if we discuss about the advantages which is attached to the systematic liquidation, the first one is entrepreneur and the owner maintain control throughout the harvest period. So in this case, harvesting means selling the assets and withdrawing the additional cash flows from the business. So even during harvesting period, ownership or the stake of control does not change. And the second point is harvesting of the investment value, it can be spread out over the number of years. So that means it would take a number of years to sell the asset and get the cash from the business. That means investors will get their investment value over several years. So they would not get the value as a lump sum amount. They will get it over the years. And the next point is time, effort, and the cost of finding buyer to sell the entire venture can be avoided. So these are the advantages of the systematic liquidation. So ownership or the stake of control does not change, and this the liquidation would happen over a year, not the overnight, and the time and effort and the cost of finding buyer would not happen in this case. But there are potential disadvantages to this method as well. The potential disadvantages of the systematic liquidation. So the first one is the treatment of taxation of liquidation proceeds as the ordinary income. So when company sells their assets, this proceed considers as ordinary income rather than the capital gains. So income tax rate applicable to these proceed is higher. And then the second point, the commitment of entrepreneurs' wealth, ability, and focus to a dying venture rather than other venture to pursue it that might be more lucrative. So, as I have told you, this liquidation proceeds, the systematic liquidation happens in over years. Therefore, the time and the abilities and focus for several years, I mean, for a longer period, will be on this dying venture. But investor, the entrepreneur can focus on another venture, another business, uh, if he would go for a quick sale, right? But in this method, so this systematic liquidation would happen over time. It would take some time to completely sell the business assets and withdraw the cash from the business, which is a disadvantage. And the accelerated rate of decline in the growing concern value, because the asset value would be depreciate or the decline uh, at a very speedy rate, uh, because everyone would know that the industry is a dying state. So normally liquidation is the least attractive exit strategy. Liquidation is the least attractive exit strategy, and except when the industry is dying or the product is dying and venture has no future, the systematic liquidation would not be selected as a exit strategy by the owners. So when venture is operating in a declining industry, so normally the advantages of the systematic liquidation outweigh the disadvantages. So this is the least attractive exit strategy. So unless the industry is dying or the product is dying, we would not select this method. Then we will move on to the next method, which is the outright sale. So the outright sales means the selling the venture, selling the entire venture to some other party. So it could be the family members, it can be managers, it can be the employees of the venture, or it can be an outside buyer. So let's say these methods one by one. So the first method is outright sale to family members. Outright sale to family members. So business venture, most of the time, the entrepreneurs or the owners like to sell their business to their family members. So this can happen mainly in two ways. One is the owner can transfer the business to the family members as a gift. The entrepreneur or the owner can transfer the business to their heirs as a gift transaction. Or the second method is they can sell the firm for cash to the family members. Sell the venture for cash to family members, or either they can use a combination of these two as well. The half of the value is transferred as a gift, and the half of the value should be have bought by another family member for cash. So combination also would work. And in this case, especially when entrepreneur is transferring the business as a gift, they should be very careful about the different tax laws on transferring the property by gift. So there are different rules, especially the tax rules applicable for this transferring of property as gift, because exceeding certain limits can lead to very high tax rates. So that is why sometimes the venture owners use the combination, where the part of business is transferred, part of the venture is transferred as a gift, and another part is purchased by using cash. Then they can avoid such high tax rates. Then moving on, the second method of outright sale is the outright sale to managers. So that means the venture, the founders can sell their venture to the managers, most of the time to the top management team. So if founder decides to sell the venture to its management team, it is called outright sale to managers. But normally we know that managers are not the investors. So therefore, normally they don't have enough funds to purchase the venture. So as a result, they would ask debt from the external fund provider. That means the management team would ask the external investors to provide funds for them to purchase the venture as with debt, because managers usually have a very limited personal resources, insufficient funds to buy the venture. Therefore, they would ask debt, they would ask the external investors to provide debt for them to purchase the venture. So if the purchase price of the venture is largely financed with the debt capital, then we call it as a leverage buyout. If the purchase price of the venture is largely financed with the debt capital, it is known as leverage buyout. So that means in a leverage buyout, the purchase of the venture is financed largely by the debt capital, and normally this debt capital is provided by the different parties. So normally this debt financial capital will be provided by the either private equity investors, or there are certain banks who would give high risk loans, and the LBO financiaries. So this LBO financiaries means these are the people who are specializing in investing high risk investments like junk bonds. So these LBO financiaries are the people who are specialized in investing high risk investments like junk bonds. So all these parties, that if someone is investing in a leverage buyout, that party can be identified as a LBO financier. Right. And normally in a leverage buyout, so the existing equity is retired using massive debt. Major part of the equity value is retired using debt, and if the managers stay continue, if the top managers continue to run the firm under LBO, then it is called management buyout. So that means the management buyout is a special type of leverage buyout. MBO, the management buyout, is a special type of the leverage buyout where the top management buy the firm with the help of debt providers. So that means the top management will have the equity position in the reorganized firm with the help of the debt providers. So they will remain running the company. So they will be in charge of handling the venture even after the purchase. So normally, when founders initially planning for a harvesting strategy, they can go for this outright sale to managers because they can attract the key management talent by suggesting them at the end of the maturity, the venture will be sold to the managers, right? So as a initial plan at the initial planning, they can go for this outright sale to managers method because it will help them to attract good managers, the very talented managers, because then the managers would know at the end of the venture, the ownership would be transferred to the managers. And normally in a management buyout, the 5 to 10% of selling price will be financed by the managers, and 95 to 85% of the purchase price would be financed by the debt finance provider. And in this method, in the management buyout, the challenge is the survival. The MBOs, in short run, survival is challenging for the venture because so after a management buyout, so as I told you, 85 to 95% is debt financing. That means there is a huge amount of debt in the firm, and they have to pay it. They have to make the interest payments, right? So this is a risky strategy, and because of this strategy is most suitable. This strategy is most suitable for companies which has a good efficient operations. If the company is well managed venture with very good efficient operations, uh, where they have a very stable operating income and where they have very stable market for their product, and they have the ability to protect that market share, then this method is more suitable. I hope you understand the riskiness of this method because the larger portion of the purchase price is financed by the debt capital. So obviously, uh, the management should have to make a large amount of interest payments in future. So therefore, to enforce this strategy, company should be the venture should be in a very stable status. Their product should be very assured, and they should have a very good market, very sustainable market where they can protect their market share, and they should have a very good stable operating income with very efficient operations. Then this strategy is suitable for such ventures. The management buyout, because at the short run they have to survive with large uh, interest payments. Here I have included an example, a situation of management buyout. So can you quickly read this question? Read this example. I would give you 2-3 minutes. So this is an example for management buyout. So here you can see the purchase price of the firm is 40 million, and the owner Ryan is like to sell the venture to the top management team, but they have only 2 million rupees of their personal equity value, and they need additional 38 million of debt. Then let's see the debt arrangement. So LBO Financiaries would like to put 20 million, 9% 5-year subordinated debt funds with 2 million warrants attached that can be converted into 2 million shares of common stock. So that means this 20 million, they have to pay 9% interest for the 5 years, and at the end of the period, it will convert it to common stock. And by exercising the warrants, the LBO Financiaries will own 50% of the venture's equity in future. And then the bank specializing in making risky loans, they will lend 10 million at a rate of 12%. So now 30 million is already arranged. So furthermore, bank will require that loan to be fully amortized over the 4 years. Finally, to get the deal done, Ryan will ask to provide some seller financing in the form of 10% 5-year, 8 million seller's note. So this seller's financing means that the owner, will provide an 8 million loan to purchase. That means he's providing him a debt of 8 million at 10% interest for 5 years. So it is like Ryan is telling the top management they can buy the firm at since they are giving 8 million, that means in cash they would the Ryan would only receive 32 millions, and the 8 million they can consider is as a debt from the owner, and they can repay it with 5 years, and they have to pay 10% interest for Ryan, right? So it is like the effective selling price is obviously less than the 40 million because of the seller's note. So in this situation, let's calculate how much the Ryan is receiving for the sale of his venture under this financial plan. If we assume that 14% is the reasonable approximation for the market interest rate. So can you all do the calculation? So now we know in the proposed management buyout, there is only 2 million in equity, right? And 38 million is in debt. So we know the 5% of the weight goes for equity, 95% of the weight goes for debt, right? And 20 million from the LBO financiaries, 10 million from the bank, and all these debt is provided to the top management, and they will provide it to the owner. And there is 8 million loan from the seller, which is repayable in 5 years. That means Ryan is willing to wait for 5 years to return his principal payment. So how do we calculate the present value of this arrangement? What is the actual purchasing price? Can you attempt? What is the actual purchasing price? So we know exactly 32 million will be received in the form of cash proceeds. And how do we get the present value of the seller's loan? You have to take the discounted cash flow values of that 8 million loan. So we know that we take the present value of the seller's loan, right? For these 8 million, the Ryan would not receive the cash at the selling point of the venture. He has to wait for 5 years. For that 5 years, management will pay an interest of 10%, right? The interest rate for the interest rate for the seller's note is 10%. Therefore, we know that throughout the 5 years, we will have a 800,000 interest payment. So we can get the present value. Here. We insert. So get the present value of this 800,000. So 1 minus 1 plus the market interest rate is 14%. 14% to the power minus 5 years, and again divided by 14%. Plus the capital value would be received at the end of the 5 years as well. So the capital value is 8 million. In 1 plus 15% to power 5. So the present value of the seller's loan would be, what is the value? Present value of the seller's loan, it would be equal to 6.9 million. If we round it up, it would be equal to 6.9 million. And so the 6.9 million rupees. So the effective selling price, effective selling price of this venture would be equal to 32 million in cash, 32 million in cash, plus the present value of the seller's note, which is 6.9 million. So which is equal to 38.9 million. So sometimes with the such LBO arrangements, the effective selling price would be changed from the stated selling price. Right here in this case, the effective selling price is 38.9 million, not 40 million. The purchasing price, even though the stated purchasing price of the venture is 40 million, with this financial arrangement, the effective selling price of this venture is 38.9 million. If seller is agreed to this value, if Ryan is willing to accept, if he consider this amount as adequate amount for the deal, then this arrangement can be done. Right. Then moving on, the next outright sale method is the outright sale to employees. This we have discussed in the previous sessions as well, where there can be employee stock ownership plans, where the employee share options. So employee stock option plans also they are as exit strategy. Here it is like earlier the venture would be given to the top managers. Now the venture ownership is transferred to the entire employee base. So therefore, this can be considered as a reward for the employees for their commitment to the venture. And most of the time, this method is used as because at the very beginning, both the employees and the owners will work hard to make the venture a success with this method of exit. Right, so employee stock option plans is also the important method of exit, and it allows the entrepreneurs the opportunity to reward the employees for their commitment to the venture by allowing them to become the new owners of the venture. And then the final method of outright sale is the outright sale to the outside buyers. Here we are discussing about the acquisition of the venture by another outside party. So it could be a competitor, it could be a customer, or it can be even a supplier. So here we are discussing about the acquisitions or the mergers of the venture with a well established firm. So normally for competitors, they will attempt to consolidate a good ventures if they have innovative product lines. So most of the time for well capitalized and well developed ventures, they will have good venture opportunities. They will have lot of acquisition offers throughout the life cycle. But at the very early stages, they should not focus on these acquisition offers because they have to focusing on building a sustainable venture. But at the latter stages, during the maturity, they can be given a serious consideration about the possible acquisition or mergering offers for the company. So when it comes to less well capitalized ventures with less of efficient operations, so when their financial conditions is not good, then they can give a serious consideration for occasional inquiries about these possibilities of acquisition, because normally for them their burn rate is high and it is difficult for them to survive. Then rather than trying to do the business alone, it might be useful for them to merge with another company. So that is with the outright sale. And then we would go to the final method of exit, which is going public. So this is the method that venture would consider as an exit strategy to show their successfulness. So this is like a symbol of venture success. So only the ventures which has a very good growth opportunities and business opportunities can go for initial public offering. Because offering stocks to public means it is a symbol of success. So in a typical initial public offering, the firm would sell their equity shares to the public investors for the very first time in public stock exchange. So for the Sri Lanka, if the firm is going to sell their shares for the first time in Colombo stock market, that is considered as initial public offering. And also it is called unseasoned public offering. So going public is also known as unseasoned primary issue. And mainly ventures would go for public offering if they have enough opportunities to expand the business and they don't have adequate capital to do it. When firms have lot of opportunities to expand, but if they don't have adequate finance, adequate capital to do that, then they can select going public as their exit strategy. So that means by going public, ventures can raise cash that is needed for their expansion very easily because large amounts can be raised through going public easily. And even they have easy access to the large funds even in future as well. They go public, they not now, they will have access funds in the future as well. But on the other hand, there are some disadvantages of going public as well. There are some disadvantages of going public. So mainly this is very expensive process because there are a lot of direct expenses related to the going public process. Normally there is 15 to 25% of the money raised by the going public will be spent for the direct expenses, which is offset by this direct expenses. And if we go public, then there will be a lot of reporting responsibilities as well because the public funds should continuously file reports with Securities and Exchange Commission, and in the stock exchange when they list, they have to prepare the public financial statement, which is not a requirement when the firm is held privately. And the next reason, the most of the companies would not go for IPO because of this reason, the loss of control. So once the company goes for the public, then the ownership will be transferred to outside buyers who can take control and even they can fire the original owners. So that means there is a huge risk of change of control. So the loss of reason. So mainly in Sri Lanka, the lack of initial public is mainly due to this reason, the loss of control. So the mostly private held business firms which are run by families would not go for public offerings because they do not like transferring their ownership to outside. Anyway, they can lose their control of the firm. And then moving on, I will briefly discuss the process of going public. So the first step is a venture or the firm that intends to sell their shares at security stock exchange. First, they have to select an investment bank. So this investment bank will act as the intermediary between the company and the buyers. and they are also known as underwriters. And this investment bank will perform mainly two services. One is called the advisory service and the other one is called the underwriting service. So they will provide advisory service as well as the underwriting service. So when it comes to advisory services, so normally the investment bank will do an equity research and decide an offer price, and they will do all the documentation work of the IPO. And in underwriting means that the investment bank will buy the stock at a lesser price than the offering price if the shares would not sell in the public offering. So normally in Sri Lanka, most of the major commercial banks like Bank of Ceylon, People's Bank, Commercial Bank, they also have a separate division for investment banking. Apart from that, there are specialized banks for investment banking as well, like NDB Investment Bank and Equity Partners. There are specialized investment banks as well. And then the second step is due diligence and advisory. So that means the investment bank should, in this process, with the investment bank, the firm has to decide which type of underwriting that they are going to do. So whether they are going for a best effort underwriting or whether they are going for a firm commitment underwriting. So there are two types of underwritings, best effort and the firm commitment. So the best effort underwriting means the underwriter does not guarantee the amount that would be raised in IPO. So he's just selling the securities, selling the equity shares on behalf of the firms under the best effort underwriting. So firm commitment underwriting means underwriter will buy any unsubscribed shares. That means they will bear the risk of undersubscribed under this firm commitment underwriting. And another part is that when firm decides to go for a public initial public offering, they have to carefully select their investment bank, because throughout this process, the IPO process, they have to deal with the support will be provided by the investment bank. So therefore, when selecting an investment bank, they should consider about the reputation of that bank and the quality of their research and the industry expertise of the investment bank and even the prior relationship with the bank. So they should consider all these factors before selecting an investment bank for initial public offering. And the third phase is pricing. So that means the firm has to decide with the help of the investment bank how much they are going to charge for one share, right? How much they are going to charge for their shares. So this is very important for the issuer, and this select the price, the issue price should be carefully decided based on the value of the company, so they can conduct a business valuation. And apart from the value, apart from the intrinsic value, they have to consider the expected demand for their security as well when deciding the issue price. They should consider the value of the company as well as expected demand for their securities. So considering both the factors, they can decide the issue price. And then fourth phase is documentation and filing. So that means in initial listing, normally there are a lot of documentation work. There is an application called initial listing application that should be filed in the Securities and Exchange Commission if you are intent to go for a public offering, initial listing application. With that application, you have to provide the certificate of incorporation and articles of association, then the extract of board resolutions. The extract of board resolution means that the board of directors should agree that the share issue of the firm is fair and reasonable. That is called the extract of board resolution. And draft of the prospectus. So in initial public offering, the offering firm have to prepare a prospectus. In the prospectus, it would include all the previous information about the financial information, balance sheets, income statements, and even the valuation of the company. So normally this prospectus, it contains all the necessary information for an investor to make their investment decision. Right? That is what we call a prospectus. So along with the listing application, company should submit all these documents: certificate of incorporation, article of association, extract of board resolution, and the draft of prospectus to the Securities and Exchange Commission. These documents and filing. Then the final phase, the fifth phase, is marketing and the placement. So once we file for the initial public offering, then we have to do some marketing as well. So normally issuing company would do road shows. We called it as road shows. That means they will make presentations to uh, prospective investors like institutional buyers and one-on-one meetings with prospective investors. So normally they would do this marketing activities over 2-3 weeks. And this marketing and the placement, this road shows will help the investor. That means will help the company or the investment bank to gather some information about the demand for their shares as well. And then finally the sale and the listing, where the company would issue the stocks at a certain date in the stock market. So these are the steps of going public in Sri Lanka. Apart from that, I included this. We have discussed about the exit value in the previous lesson when we are discussing the venture capital methods, venture capital valuation. But I just included this. We know when deciding the exit value, mostly we use the relative valuation methods. We use the relative valuation methods, and in our calculations, we most of the time we practiced our calculations with PE ratio, price earning ratio, right? So if we give the price earning ratio, then we can get the exit value, right? But apart from the PE ratio, there are some other ratios as well, which we can use to take the exit value. So apart from the price earnings, we can take these ratios as well. Like price to pre-tax earnings, we can take price to cash flows, price to EBITDA, price to dividends, price to sales. Likewise, if these multiples also can be used for relative valuation. Right? This is just an additional multiples that we can use for relative valuation. I just included this because we haven't discussed these multiples in previous calculations. Right. So with this, today's lesson is finished